Good day, everyone. My name is Fratt Okoniewski. I'm Vice President of Investor Relations at the Orion Group Holdings. Along with me, we have Robert Tabb, our Chief Financial Officer. We're excited to be presenting at the NobleCon17 virtual conference, and we will go through our slide presentation for you and open up for Q&A after the presentation. But before we get started, we'd love to point your attention to our safe harbor statement. Pretty self-explanatory. We'll not read through its entirety, but would love to point you to that and get started with our presentation and introduce Robert Tabb, our Chief Financial Officer.
Thank you, Fran, and thanks everybody for joining us. When the story of Orion, it starts with our core values, and you'll see this interwoven in the discussion and the strategy and all of the topics. They hinge on quality, production, safety, and integrity in everything we do, and how we operate. We try to stay true to our core values. Quick company overview. We think about our business in two real segments. Marine and concrete at the enterprise level, trailing 12 revenues of roughly $740 million at the end of Q3, 53 million in adjusted EBITDA, and a backlog of 429 million. We are ORN on the New York Stock Exchange, headquartered in Houston, roughly 2,300 employees that can fluctuate from time to time. Jumping right into the presentation here, today I'm going to talk a little bit about our diversified end markets, our unique ability to deliver turnkey products to our customers. Then I'll really dive into our specialized equipment fleet on the marine side. And then we'll talk about some of our operational transformation and how that's flowed through the P&L. So starting with our geographic footprint, Orion operates in 4 different time zones from the northwestern tip of Alaska all the way down into the Caribbean, and that's on the marine side. Our concrete business operates in the 3 largest markets in Texas: Houston, Dallas, and Austin, and I'll talk a good deal about the building sector in a bit. So starting with our macro drivers, the marine business is fundamentally driven by the movement of people and goods near or along waterways, so building marine transportation facilities and doing dredging. The concrete business is driven by population growth, so as populations move to a particular region, we see a demand in retail facilities, religious facilities, warehouses, educational, and obviously residential. So starting with the marine segment, the thing I'll point out on this slide really is the top 2, marine transportation facility construction and dredging services, which make up the bulk of our revenue. So on the marine transportation facility side, you see cruise terminals, bulkheads, wharves, port facilities, liquid cargo terminals, to name a few. And then the dredging service, we use it as a complementary to our marine business so that we can control the critical path. And we do a lot of intercoastal waterway dredging. Then we get a little bit of hurricane restoration work. Our marine fleet is our pride and our joy. We think that this gives us a competitive advantage. We operate over 300 vessels and pieces of equipment. We have a sizable, replacement value, but we think that our uniquely positioned equipment allows us to offer turnkey solutions and really control the critical path, which we use to, create a competitive advantage and get work that other contractors can't get. Moving to the concrete business, we acquired into this space in 2015 via the TAS acquisition, and we subsequently did a deal in 2017 to get into the Austin market. But today we operate in Houston, Dallas, and Austin. Houston, we have considerable market share. Dallas, we are expanding and gaining market share. But Austin is where we think we see a significant opportunity for growth, and it's going to be a big part of our growth strategy going forward. We think it provides us a pretty long runway, a wide runway to continue to grow that business. We think about the commercial concrete business in really three buckets. The first bucket is light commercial. We think of that as horizontally poured concrete. So think of tilt wall construction. Best example I can give is a Best Buy type structure where you pour the walls and you set them up. The second space is in the structural space. So elevated concrete pouring, columns or elevated beams. I think of stadiums, high rises, and vertical residential complexes to describe our structural business. And then finally, industrial. Industrial speaks to warehouses, manufacturing plants, and water treatment facilities. When I think about the both businesses, the customer mix is different. The marine business has a mix of federal, state, local, and private customers, which can fluctuate from period depending on where the work is. Whereas the concrete segment is roughly 85 to 95% private sector. One of the biggest questions that I get from time to time was, well, does the customer type really drive the margin profile? And typically it doesn't, because we target projects that we can get the highest and biggest return on our efforts. So we chase after the projects that have the biggest prize and award. So it's really the type of service that drives that margin profile as opposed to the customer type. On this next slide is some recent awards. Port of New Orleans, it's listed as a marine project, is one of our industrial, which I'll talk about here in a couple of slides. This tower structure project that we announced back in Q2, it furthered our strategy in Central Texas. It's a structural project in Central Texas. So our strategy with moving into Central Texas, this is a good example of that. So looking at backlog levels, backlog peaked in 2019, and at the end of Q3, it was down a little bit year over year, due to some of the timing of projects pushing out because of COVID. We still continue as of today to see strong demand for our services, and I expect backlog to start building back in the next several quarters. I expect, not to talk too much about Q4, but I expect to see a book-to-bill near or above 1 time to demonstrate that market and awardings coming back. The next slide, just to touch on industrial. We've talked about industrial being, the next effort for expanding our services. For people who are new to the story, historically, the marine business has serviced industrial customers and stopped at the water's edge. Our industrial sector strategy involves taking those services from the edge of the water into the upland piece of work. That's going to involve taking the talents from both segments and expanding our addressable market. So the marine customers will be industrial customers, and will provide services. And on the next slide on this slide it gives a good example of the services that we will offer. So we're offering, mostly existing things that we do today. So we won't be getting over our skis, doing things that we haven't had experience with. We drive a lot of pile today in the industrial space for tank foundations. There's a lot of pile driving in that, so it fits with our core competencies. Moving to recent annual results, as you can see, we hit a tough, rough patch in 2018. Faced, weather delays, and we had some adjustments to a large project that's completed. We underwent operational transformation in 2019, and we saw substantial improvements year over year. And then 3 quarters through 2020, we're seeing that full effect of the ISG initiatives that we put in place. We've been able to expand margins by project execution, but mainly in controlling indirect costs. Indirect costs on human capital and equipment capital, getting full utilization in cutting out waste. And I'll talk about that a little bit more on the next slide. The other thing that I would like to point out on this slide is the free cash flow, operational cash flow on this slide, but the free cash flow profile still fits this bill. You can see in 2017 we're about 34 million. It dipped down to 21 million. It was negative in 19, and then through 3/4 of 2020, it's been the highest that it's been in company history with a quarter to go. And I expect to continue to see us build upon that success that we've had on generating free cash flow. Moving toward more recent results, you can see year-over-year Q3 improvements. Revenues were slightly down due to some tropical weather, but profitability was up, driven by project execution and just better utilization on human capital and labor utilization. If I can remind the group, when we launched our ISG initiative, we were focusing on a couple of key areas. One, project execution. So that's bringing in projects at or above margins, bid margins. And the other area was labor management, which really focused on two areas. People who are hired to work on revenue generating projects, that we actually utilize them and have better continuity in between projects so that we don't see margin erosions from people on the sidelines. And then the other one focused on, delivering, our labor, at or above, our bid expectations. So if we say it's going to take 10, man hours to drive a pile, we need to beat it or come in at that amount that we budgeted. And we've seen those margin expansions from better execution. The other two areas really focused on, one, equipment, and then corporate processes. So equipment, we review and continue to review our fleet to make sure that we have pieces of equipment that we can fully utilize or justify owning. So we've shed underutilized assets, and we've invested in the ones that we can earn a superior return on, and we've seen a tremendous amount of improvement in our ability to recover our equipment year over year, quarter over quarter, and that's reflected in these numbers. And then the last area focus on corporate processes and SG&A. We've made some people changes. We made some process changes. We've been able to expand EBITDA margins by improving our SG&A profile. But we expect to expand upon that as we launch into ERP. We talked about it the last few quarters. We're working on ERP, and we think that the bigger gains comes once we get on the other side of ERP. So moving to the balance sheet in closing before I turn it over to Q&A. Our balance sheet is in a strong position, best it's ever been, at least in the last 10 years. Leverage is low, roughly around 1 time. We have access to roughly 75 million under the revolving line of credit in our current cash balance. And our bonding position and capacity remains very, very strong. One thing that I'll point out that I know, I'll get a lot of questions on. In previous quarters, we talked about some of the liquidity events around the real estate sales. Quick updates on that. Port Lavaca, which we have a deal for, that's 5.5 million. The ball is in the court of the buyer. They're trying to finalize their financing. Their bank and lending institution is going through their final paperwork, and once that settles, we'll have a better idea of when that deal will close. Moving to Tampa, that deal is in place for 23.75 million. That deal is close to closing. We have a rezoning hearing that is scheduled for February 11th. Once that rezones, that will clear the way to closing. So the way that the contract is written is that they have 30 days after rezoning to close. All indications that I'm getting is that once it rezones, they'll be ready to close quickly. So good chance maybe that happens in Q1, but it could be an early Q2 event. And then finally, the property on the ship channel here in Houston, getting good momentum, a lot of interest in that property. No official offer in place or deal in place, but I think we're getting close. Once we do have something official, we'll have more to say on that. That property right now is currently listed for $45 million. I think we'll get somewhere between 35 and 45 million is what I would expect. With that, I'll take a step back and open it up for Q&A.
Great. And for the watchers, there's a small box on your right lower hand corner that's a bubble if you'd like to submit a question online, and I'll try to incorporate. I'll take it from here, though, Robert. And can we just, one would walk through your segments a little bit and first talk about the marine segment. And can you just give us an idea of sort of the tone of bidding activity? You know, we're all coming out of a challenging year last year. And even though that was pretty challenging, you guys executed really well. What's bidding activity look right now? What's your visibility for the first half of the year? And then some of the recent awards, were those included in your low bid pending award number when you talked about it on your third quarter conference call?
Okay, so two questions there. The first one is we're pleased with the bidding environment. We sit in bid reviews being marked depending on the size and level of it. It's been a active start to the year. So bidding activity has increased as the calendar year turned to 2021. We'll have more to say on some potential awards, in the next week or so. But very, very pleased with the level of opportunities that we're seeing. The activity has increased as we expected it to. I think as the vaccines become more widely available, I think that confidence will continue to grow, especially in the private sector. And then as the new administration takes hold, I expect to see more government spending, which should definitely help and be a driver for our end markets. As far as your second question about what's in the low bid, most of the stuff that was in low bid at the end of Q3 is materialized into awards, and some of the things that we'll be talking about will be new things that we haven't talked about before.
Okay, great. Thank you, Robert. And then on the marine side, you did have a setback in August in Corpus Christi. You've talked about trying to replace that capacity. Can you just update us on your plans to replace the Wayman Boyd?
Yeah, no real update on what the final decision is going to be, on how we replace that capacity. Right now, we have the number of dredges and the crews to be able to execute on the work that we have in backlog and to support the bidding activity that's coming up. But we hope to finalize that decision sometime in Q1 on what the next piece is going to look like, whether we build something from scratch, whether we buy something, or whether we retrofit one of our boosters and put it back into service. But I can say this, that our current capacity is being met. We're executing on the work that we have in hand, and we don't foresee any capacity issues with the current bid schedule that we have, that we see in front of us.
And also the insurance accruals and everything should be already, accounted for on your balance sheet and have already run through your income statement.
On the income statement side, yes, we don't anticipate to see any more P&L adjustments. The liability accounts, as negotiations happen with insurance companies and all parties involved, you can see that liability count. It adjusts from period to period, but the P&L impact is flowed through already in Q3.
And then when we look at Marine, Marine did have a reasonably good year last year. The fourth quarter looks, as you sort of said, it's hard to tell, or you can't really talk about it yet, but we're expecting it to be, a decent end to the year. Can you that was the Marine performance was really without any tailwinds from the cruise sector, which was hit pretty hard. Can you talk about when you might see some cruise-oriented work materialize?
Well, yeah, some of the stuff at the cruise lines industry is a little bit early to talk about, but what I can say is that there's been some conversations about some projects that had stalled, about potentially, firing up those conversations and having those discussions about pricing and potential timing. I think this all ties back to vaccinations and the marketplace getting comfort that things are going to return to normal. I think businesses, especially like the cruise lines, they want to be out in front of it. They want to get their maintenance work done before they start selling again, so they don't have further disruptions once things return more to normal. But the thing that I can report is that we have had conversations with some of our key customers about potential work that we could be doing this year to get them up and running.
Okay, great. And why don't we switch over to the concrete sector and just talk about sort of the state of the market there. One thing that I think that has created a little more tailwind going into 2021 versus 2020 is not only COVID and maybe potential less restrictions, but now we have energy prices that have rebounded. And, corporations are, it seems like, thinking about moving to Texas. Can you just update us on bidding activity and sort of how those trends are how those potential trends are translating into bidding activity?
Yeah, no, very, very pleased with where we are from a concrete standpoint. We've seen a very, strong bid list and activity. The recent awards, we'll have more to talk about some recent awards, as I alluded to earlier, but very, very pleased with where concrete is, some of the work that we won over the fourth quarter, and we've seen an uptick in activity here with awards, even in the first 2 or 3 weeks of this year, really aided by the warehouse distribution space. We're seeing an explosion of activity there. There's a lot of structural opportunities. If I had to guess, I would think that we will continue to see strong markets from the concrete side of the house a little bit quicker than the marine. But very, very pleased with where that's shaking out. The Austin market is very, very strong. The Dallas market is very, very strong. We're getting a lot of bid opportunities in work that's right in our wheelhouse. So very, very pleased with where the bidding activity and where the marketplace is on the concrete side.
And then when you look at sort of how you operate that business and the model, can you just talk about maybe strategic goals of expanding that business and maybe even look at, areas beyond Texas and sort of how you might, think about those opportunities and implementing them?
Yeah, absolutely. A lot of our customers are national players, and we have good rapport with them when we have solid relationships. There's conversations, that's being had about expanding our strategy into the Florida markets, for some of the GCs that we work for here in Texas, which makes a whole lot of sense because we do have a base of operations in the Tampa office and area that we can expand upon and use. But there'll be more to discuss on that. But we're actively looking at that and taking that show into the Tampa market where we think that we can do quite well. There are some opportunities that have popped up in the Louisiana area, which is not too far from where we are today. That could be advantageous for us. But we're really excited about Dallas and Austin, Central Texas, being big drivers to growth. Adding structural opportunities in Dallas should help us expand our market share. Doing light commercial and structural in Central Texas should provide a big runway avenue for growth as well. But we're going to have some opportunities to look at some markets that we're currently not in. and to piggyback off of some of the existing operations on the marine side, in Tampa, to be able to have a place to operate out of, and provide commercial concrete services in the Florida market.
Okay. And the gating factor, Robert, to that would be not asset or capital. It would be more just building the bandwidth from a personnel standpoint. Or can you sort of give us a flavor for that?
Yeah, it's going to be business development and labor. Labor are going to be the key drivers. But we have a couple things going for us. As I mentioned, we have a base of operations in Tampa, so we are tapped into the labor markets, and we feel comfortable with being able to recruit. But we also have a strong base of operations here in Texas, and we have people that are willing to travel, so labor won't be an issue, but it is something that we're going to have to work toward and make sure we're able to staff up for.
Oh, you want to mute.
Sorry, not sure how that happened. I apologize. If we could just talk about, marrying the two segments and capturing sort of the shoreline from the offshore and looking at the industrial strategy. You talked about the contract in New Orleans. Are there other examples of that yet? And then at what point in time would you might break that out into a separate segment, or would you ever?
Yeah, the SEC has strict guidance around when something meets the criteria for a reportable segment. I think at some point it will become its own separate segment. But that's going to be really dependent on those criteria and the factors that's laid out around percentage of revenue and percentage of profitability. When we hit that threshold, we'll obviously do that. But to answer your question around where are we in kind of that strategy, the Port of New Orleans job is the largest one right now that we have in the pipeline, that we have in backlog, I should say. But there's others in the pipeline that we're actively bidding and pursuing. There's a couple of smaller ones that we're working. Nothing to note at this point, but we see our fair share of opportunities, in the upcoming quarters that should really help us take that next step in 2021 to really expand upon our industrial strategy. I believe there's 4 or 5 bids for industrial type work that we're going to be submitting in the next 30 days or so. So very, very pleased with the pipeline in the bid activity in the industrial space.
And is this, Robert, a function of just putting the two teams together on the marine side and concrete to come up with bids and, be more actively bidding into that market? Or sort of can you help me understand sort of how you're molding the two divisions into the industrial segment?
Yeah. If you go back to kind of when we first introduced this strategy, the whole thought process behind it was, the marine business, has a reputation with, these blue chip companies, energy companies, and industrial companies, and we have the safety record that is required and the relationships that is required to get on the bid list. We want to be able to take our services and expand upon that. So doing industrial concrete, doing pouring foundations for tanks, and just doing some of the work that we do on the commercial concrete side and do it in an industrial environment. Obviously, to get into an industrial environment, you have to have an impeccable safety record, which we have, and you have to have a relationship. So it's really expanding upon the foundations of the relationships and the safety record that we built over the years to expand our addressable market. So the commercial concrete, we pour more concrete than just about anybody in the state. Taking those talents and doing it in an industrial space where there's less competition and you typically get higher margins. So that's the thought process behind moving into the industrial space.
Yep, and you talked about, the ISG program, the Invest, Scale, and Grow program, and, you talked about some of the broader areas. Can you quantify, Robert, how much of an impact that had to the bottom line, or is there a metric we could look at to sort of see how much of an improvement that program actually generated?
Yeah, we haven't talked publicly about specific numbers, but I think if you go back to my comments in Q2, I hinted at some, basis points improvement. I think it was over 1,000 bips in the marine business, driven by labor utilization and equipment utilization. But it is a significant improvement, to the tune of, over $10 million of turnaround, from, labor utilization and equipment utilization. So the lion's share of that has come from, improved efficiencies with assets and human capital, and then a smaller share, but a decent, notable share from margin expansion, due to project execution being better than bid margins. Over 10 million, on the labor and equipment side, to give you kind of a ballpark, but we haven't quantified exactly, to the marketplace exactly, what those dollar amounts are.
Yep, and they are durable too. I mean, they're not just temporary one time. They change the culture. They change the structure.
Yeah, absolutely. One thing that I'll point to is over the quarters you've seen some fluctuations with the volume. Sometimes they're higher, sometimes they're lower. But that margin percentage has been solidly over double digits every quarter. I think if you go back to previous years, you could see it dip up and down, single digits to high digits, double digits. I think, where we are in the way that we're operating now, we'll comfortably be over that double digit threshold. That just speaks to, labor management, equipment management, and being very efficient with our resources.
Hey, Paul, it's Fran. I would just point you, back to Q3 where, in terms of ISG and its cultural impact, which is ongoing, you saw sort of a modest or maybe slight decrease on top line last quarter, but you saw up close to a 15% growth in EBITDA dollars. And I think that's just an example of what, this ISG is presenting to the whole organization as it sort of rolls through each segment.
Yep. And then, Robert, can you just you talked about the ERP, can you talk about the timing of implementing the ERP system? And then, just, I guess, give us an idea of, how much you expected to spend in this year and next year fully implementing it?
Yeah, I think it's going to take the middle of 2022. And I get a lot of questions. Why so long? The marine business and the concrete business they're on two separate platforms and systems. We're going to combine them and move them to one. They operate with different policies and procedures. We're going to consolidate and rearrange processes to streamline the back office. So as I sit here today, I have two sets of HR policies, two sets of IT policies, and two HR departments and two IT departments. The accounting groups are merged, but we still have accounting policies for the marine group and accounting policies for the concrete. So there's a good opportunity to consolidate and to streamline. So it's not just systematically changing over to a new system. It's a massive process change, and also building upon what we had in place on the marine side. So the marine side was more tailored toward a publicly traded company, but there was a lot of inefficiencies, or there are a lot of inefficiencies in that system that we're going to hammer out and to push through. So we roughly laid out the middle of 2020, 2022 of go live date with a price tag of roughly $15 million. I think that we'll be somewhere around $1.5 million at the end of 2020, and I would expect the spending to ramp up starting, late Q1 as we move into that build phase and we start to build the system out. But long term, I think this platform sets us up to really grow the company. As we execute on our real estate strategy, I think, capital allocation becomes a hot button topic around, where do we put the dollars? Is it stock buybacks? Is it dividends? Is it, acquisitions? I think that, those questions and that conversation, definitely is right around the corner. But, ERP, I'm excited about it. I think it's transformational. And I think it becomes a platform of the future and really allows us to grow this business beyond $1 billion, beyond $100 million in EBITDA that we've talked about for the last several years.
And Robert, you sort of preempted the line of questioning that I was going to follow, but I appreciate the asset sale updates, a lot more specific than what I've heard before. And so, you could potentially over the first half of the year generate, close to $30 million in overall proceeds if everything closes, and there shouldn't be much tax leakage at all. So, can you give us a little more color on sort of what you're thinking right now, or maybe what the priorities would be if you could just, in order of, acquisitions or stock buybacks or maybe potentially dividends, sort of, would you order it in that fashion, or would you have a different order?
Well, right now, according to our credit agreement, the way it's written, paying down debt is requirement. As we get closer to those dates in the next month or so, depending on what's available and what opportunities are in the marketplace, we'll have to adjust that and look at it. So right now, the priority, the stated priority, is going to be pay down debt. But acquisitions and if the opportunities are out there and it makes sense, and we can get good value, we're definitely going to explore that. But everything's on the table. Buybacks are on the table. Dividends are definitely on the table. And as we get into 2021, we'll have more to say about that. Nothing to announce today, but I can say this much, that all of those avenues are definitely on the table. There are things that we're having internal discussions about, and at the management level and at the board level.
Yeah, better to not spend it before you have it in the bank.
Exactly. That's my thinking too.
What and then we have just a time for one more question, and you sort of alluded to it before, but do you see a meaningful tailwind created by any stimulus legislation that might come out of Washington with the change in administration, or is it just reinforcing what is already happening in the business as far as looking at 2021? I guess another way to say it a little more efficiently is, do you think stimulus legislation will change your 2021 outlook at all?
Yeah, it depends on kind of the timing of it and when it happens. So whoever you ask this question to is probably give you different answers. I am very bullish on infrastructure, especially with both sides of Congress, in the presidency, executive branch, in one party. So I think it's an area that both sides agree on. But now you can ramshack this through on party lines. I'm very, very bullish that this is going to happen. It's going to happen. It's going to happen soon. Depending on how it plays out and how it's actually drawn up, how it's going to impact us, is TBE. But I can tell you this much: a rising tide lifts everybody's boat, right? So the more dollars that are in the system, it's going to eat up capacity and create opportunities for us to expand margins. The other thing that I'll definitely point out with my beliefs, and we'll see how this plays out over the next several months. I think COVID, the slowdown with COVID last year, is going to create pent-up demand. I don't know when that pent-up demand is going to, release itself. I'm happy with the bid list. Maybe this is the early starts of that. But I think that's also going to be a driver that can help out. But it all just depends on the timing of it. If it happens earlier, the more